There's 4 major credit score and banking changes Trump will introduce starting in 2025.
Cut. We're going to put a temporary cap on credit card interest rates.
We virtually shut down the out-of-control CFPB, escorting radical left bureaucrats out of the building and locking the doors behind them. You start opening your bank to conservatives because many conservatives complain that the banks are not allowing them to do business within the bank, and that included a place called Bank of America.
On making government better, more efficient, and smaller. And that's what we're doing.
If you have a credit card, a bank account, or plan to borrow money in the near future, this is critical information that you don't want to miss because it affects millions of Americans. And in a second, you'll see how credit card interest rates could drop by nearly 60%, putting thousands of dollars back into your pockets, how we might be heading straight back to 2008 when banks were handing out loans like candy, and how the CFPB is under fire, meaning customer protections are vanishing. And trust me, the banks are loving every second of it. But listen, there's one thing that hasn't changed. Banks still want to dig through your credit report every chance they get. If you're tired of getting hit with unnecessary hard credit pulls just for checking your options, I got you covered. I put together a free credit card pre-approval master list with over 60 cards you can check out without taking a hit to your score. Some even show your starting credit limit with just a soft pull. I update it every single month, and I'll leave a link below so you can check it out. If you've ever looked at your credit card statement and thought, how is this even legal? You're not alone. Millions of Americans are drowning in credit card debt, with interest rates skyrocketing past 25%, 30%, or even 35% on some cards. This is where Donald Trump comes in. Back in September of 2024, during a campaign rally, he made a bold promise: a temporary cap on credit card interest rates. He said, while working Americans catch up, we're going to put a temporary cap on credit card interest rates. We're going to cap it at around 10%. We can't let them make 25 and 30%. Now, the key word here is temporary. This isn't a permanent solution, but rather a short-term fix to provide relief to Americans struggling with debt. But the big question is, will this actually happen? Or is it just another campaign promise? So Trump argues that banks and lenders are gouging Americans, raking in billions while families struggle to afford essentials like groceries, gas, and rent. And this isn't just a Republican idea. Even Senators Bernie Sanders and Josh Hawley have introduced similar proposals, showing that there's some bipartisan interest in regulating credit card interest rates. And with the current average credit card APR sitting at 24.21%, this temporary cap could slash interest rates by more than half for millions of people, but only for a limited time. This probably sounds like a win, right? Well, not everybody is celebrating. The thing is, credit card companies hate this idea. It's because it would dramatically cut into their profits. Right now, credit card interest is a massive moneymaker for banks, pulling in over $120 billion per year in revenue based on a 2022 CFPB study, and it's likely much higher now. If banks can't charge higher interest rates, they might stop lending to people with lower credit scores altogether. So instead of offering 10% interest, lenders might just deny more applications or add higher annual fees to make up for the lost revenue. Some experts predict this could push borrowers toward payday loans, pawn shops, and other high-fee lenders, making things worse, not better. So while a temporary 10% cap sounds great on paper, the reality could be that fewer people get approved for credit cards at all. Now, regardless of whether this temporary cap happens, one thing is certain: banks will adjust their lending policies. If the cap is enforced, expect credit to tighten up fast, and if it doesn't, expect interest rates to keep climbing. And here's what you can do to prepare. You can pay down balances while you still can. So if banks start restricting approvals, your existing credit limits will become even more valuable. Paying down balances now can help protect your score and your available credit. And then you can boost your credit score. So if lenders start cherry picking only the best borrowers, you need to make sure that you're in that top tier, keeping utilization low, that means below 10%, and avoid late payments, that means 100% on-time payments. And I find the likelihood of this happening is actually very low. Let's be real, this is a long shot. Banks have massive lobbying power in Washington, and you can bet they will fight this with everything they've got. Even many Republicans don't love this idea. While Trump is pushing for it, many free market conservatives oppose government-imposed price caps. Since this is only a temporary cap and the policy's impact and timeline would be limited. Now, unless Trump finds a way to enforce this via an executive order, which is legally questionable, Congress would have to pass a bill, and that's a tough sell. So I'd say there's a low chance between 10 to 15%. It is a headline-grabbing campaign promise, but it's unlikely to make it through Congress without major pushback from the financial industry and lawmakers. Even if it does pass, it would likely be short-lived, so don't count on this as a long-term fix. Next, Trump is 1000% going to push for bank deregulation because he's done it before and he's already signaling he'll do it again. But to understand why, we have to go back to 2008. That's the time when banks were falling apart, the stock market was in free fall, and everyday people were losing their homes left and right. To stop the chaos, the government stepped in with the Dodd-Frank Act. That was a monster-sized law designed to put banks on a tight leash, limit risky lending, and protect consumers from another financial disaster. Now, fast forward to 2018, and here comes Donald Trump, pen in hand, ready to shake things up. With the Economic Growth, Regulatory Relief, and Consumer Protection Act, Trump slashed key parts of Dodd-Frank, arguing that smaller banks were being crushed under piles of unnecessary regulations. His goal was to make it easier for banks to lend money and then boost economic growth. And now Trump is back in the driver's seat, and he's signaling another round of big-time deregulation. Just on January 31st of this year, he signed an executive order requiring federal agencies to eliminate 10 regulations for every new one created. Yeah, that's 10 to 1. That's double the aggressive deregulation approach from his first term, where he aimed for a 2 to 1 rollback and ended up eliminating 5.5 regulations for every one new rule. So I know bank deregulation is a hot topic, and let's be real, it's not all good or bad. There are some upsides, but also some serious risks. The upsides are it's easier to access loans and credit. So if banks don't have to jump through hoops to lend money, getting a mortgage, a business loan, or a credit card could become way easier. It could boost economic growth. So the idea that less red tape equals more lending, equals more business expanding and hiring and fueling the economy. And then the small banks could benefit. So big banks can afford to deal with complex regulations, but smaller community banks often get crushed by compliance costs. So rolling back regulations helps them compete. And you could see more innovation. So with fewer restrictions, fintech companies and alternative lenders can get creative and bring new financial products to market faster. Now, the downsides are risky lending could lead to another financial crisis. So remember back in 2008, banks gave out way too many risky loans, and when people couldn't pay them back, the whole system collapsed. Loosening lending rules again could bring deja vu. And then there'd be fewer consumer protections. So you can say goodbye to caps on overdraft fees, fair lending rules, and limits on shady banking practices. With fewer rules, banks can raise fees, hike interest rates, and then change terms whenever they want. And you also could see more bank mergers and less competition. So fewer banks means fewer choices, and that's exactly what's happening with Capital One's planned $35 billion acquisition of Discover. If this deal goes through, it eliminates a major competitor, leaving consumers with fewer options for credit cards and banking services. That could mean higher fees, weaker credit card rewards, and worse customer service because, well, where else are you going to go? And then less competition equals banks don't have to fight as hard for your business, and that's never a good thing for us consumers. And if banks take too many risks, we all pay for it. If banks get reckless and start collapsing, guess what? The government, also known as us, taxpayers, might have to bail them out again. And I find the likelihood of deregulation very high. And that's because banking deregulation is one of Trump's signature policies. He's already rolled back regulations before, and he's likely to do it again. Plus, the financial industry is heavily lobbying for fewer restrictions, meaning there's strong momentum behind these changes. So moving on, imagine you're fighting a fraudulent charge on your credit card, disputing a medical bill that you don't even owe, or trying to get a bank to refund unfair overdraft fees. Now then imagine there's no one to help you. That's the reality we could be heading toward as Trump moves towards weakening the Consumer Financial Protection Bureau, or CFPB. That's the agency that's been fighting for consumers like you since 2011. The CFPB has forced banks to return over $21 billion to consumers. They've gone after predatory payday lenders and cracked down on hidden bank fees, but now it's being put on ice. And if you think this won't affect you, you got to think again. Trump's administration has paused key CFPB regulations, including the removal of medical debt from credit reports and other consumer protections. Rohit Chopra has been replaced by acting director Scott Bessent, signaling a major shift toward weaker enforcement of consumer protection laws and a more hands-off approach to regulating banks. And new Biden-era CFPB rules such as caps on overdraft fees have been frozen and could be completely repealed under Trump's leadership. And all CFPB investigations, rulemaking efforts, and enforcement actions have been halted, leaving banks, lenders, and credit bureaus with far less government oversight. So some people think cutting back on the CFPB means less government interference. Others think it gives banks a free pass to do whatever they want. So what's the truth? Well, the upsides are it's going to be easier to get loans and credit. So with fewer rules, banks might approve more people for loans and mortgages and credit cards. And some people want less government involvement, so they see that as a good thing. Some argue that CFPB goes too far, making banking more expensive with too many restrictions, and that cutting back means banks have more freedom. Now, the downsides are there's going to be more hidden fees and surprise charges without strict rules. Banks could start sneaking in more fees on credit cards and loans and bank accounts. And it's going to be harder to fight fraud and disputes. The CFPB forced banks to refund billions for shady practices. With fewer rules, getting your money back after fraud could be a nightmare. And then there's the predatory lenders that could make a comeback. Payday lenders who charge crazy 300 to 400% interest rates could get more freedom to operate, making it easier for people to fall into debt traps. And let's not forget, the CFPB helped with fixing credit report mistakes, and that's going to be harder. Right now, if a bank or a credit bureau messes up on your credit report, you can file a CFPB complaint to get it fixed faster. But if the CFPB weakens, it could take way longer or not happen at all. Now, I find the likelihood of this happening is very high again. The CFPB is already being weakened. Trump has already paused those CFPB rules, and there's a strong chance he'll continue rolling back more consumer protections. And unless Congress steps in, you're going to expect less protection for consumers and more power for the banks and lenders. Now, have you ever had your bank account suddenly shut down with zero warning? One day you're paying bills and shopping like normal, then bam, your card gets declined and your funds are locked. And when you call customer service, all they say is, we reserve the right to close your accounts at any time. That's called debanking. And over the last few years, it's become a huge problem, especially for small business owners, crypto investors, firearm sellers, and political organizations. And here's the thing, banks don't just wake up and decide to close accounts for fun. They do it to avoid risk, comply with government regulations, and protect their reputation. But lately, it's happening more often, and a lot of people want to know why. What I found is that under Biden's administration, banks face tighter ESG, or environmental, social, and governance rules, and AML, which is anti-money laundering policies. That meant they proactively shut down accounts they saw as high risk to stay compliant and avoid fines. And here's who've been hit the hardest. First is crypto businesses. Banks were worried about money laundering risks, so they cut ties with many crypto-related companies. And then there's the gun retailers, or firearms companies. Some banks even stopped working with firearm businesses as part of their corporate social responsibility goals. And then there's the right-leaning political groups and controversial figures. While debanking can happen to anyone, conservative groups and businesses have been the loudest about it, claiming their accounts were closed for political reasons. Banks, however, often say it's due to reputational risk or compliance policies. And we can't 100% prove political bias, but the fact that certain businesses keep getting targeted raises serious questions. And this isn't just happening in banking. Remember when Facebook's Mark Zuckerberg admitted the Biden administration pressured social media platforms to censor certain content? If the government can push big tech to control speech, why wouldn't they also pressure banks on who they should and shouldn't do business with? And Trump isn't staying quiet about this. If there's one thing he's known for, it's shaking things up, and debanking is on his radar. At the World Economic Forum, he directly called out major banks, including Bank of America's CEO. He said, "I hope you start opening your bank to conservatives because many conservatives complain that the banks are not allowing them to do business with the bank." But he's not just talking, he's already taken action. Trump recently signed an executive order stating that protecting and promoting fair and open access to banking services for all law-abiding individual citizens and private sector entities alike is now official administration policy. So if you've been worried about losing access to your bank account because of your business or industry or views, this could be a major shift. With Trump removing the regulatory pressures that push banks to debank certain customers, they won't feel the same need to drop accounts just to stay in line with government expectations. And I find the likelihood of this happening high. Trump has been vocal about stopping debanking, and banks tend to follow the administration's lead to avoid legal scrutiny and political backlash. Also, with fewer regulatory burdens, banks will feel more comfortable keeping accounts open rather than closing them down. So the bottom line is, if Trump sticks to his word, we could see a big drop in debanking over the next few years. And if fewer people are getting debanked, that's a win in my book. But you know what would be an even bigger win? If the government just started handing out money to people. And that's exactly what some are saying could happen with Trump's potential $5,000 DOGE stimulus checks. That's a move that could pump billions back into Americans' pockets. That sounds like a game changer, right? Well, here's the catch. Not everyone is getting paid, and the numbers behind this so-called stimulus, they don't quite add up. So in the next video, I'll break down who actually stands to benefit, why some people will never see a dime, and even if the checks don't happen, how millions could still walk away with serious tax savings. This is one you really don't want to miss. So once that video drops, I'll leave a link to it right here so you can click on it. But thank you for watching.